Last week, we started discussing financial markets. And I remember we only had 1 hour discussion on the financial markets, and then we switched to the handout with questions. Some of you, I think most of you, liked the session discussing the questions and answers, and you have requested to have that type of discussions frequently. We'll try to find some time to discuss some of the questions like that related to our exam. Now, before we move on to the session, I think you have two messages from IBSL. One, I think they have shared an evaluation link, class evaluation link. So please feel free to find your time, even during the session or after the session, to fill out this survey form. I think it's a Google form. So please make sure that you fill out the form that is needed, because to ensure that we maintain our standards and also to improve our standards in the future sessions. So please help them with filling the form. That is the first thing. And the second thing, I think very soon they will be publishing these question and answers, a set of question and answer. Then you can download it for free. That was also mentioned by the IBSL. So those are the two messages from my side. Now
Excuse me, sir. When they will conduct the, when they plan to conduct exam, is there any close by November?
after November, in the
Uh,
month of November, revisions are scheduled. Because I think given this situation now, still the A-level exam is not confirmed, the dates. So I think your exam will be dependent on those dates as well. So what I heard from them, that will be after November, uh, but date is not fixed yet. Revisions would take in November.
okay, sir. Thank you.
Thank you. Uh, sorry. So we looked at different financial market conditions, especially the financial risk was discussed. Risk return trade-off we have covered. Diversification and hedging were the means of risk reduction strategies we have discussed. And then we started classifying the financial markets. We classified or grouped the financial markets based on various characteristics, such as the nature of the claim, maturity of the claim, and also timing of the delivery, organizational structure. These are the key considerations that we have taken to classify the financial markets. And I remember we also started discussing the primary market and secondary market concept. Then based on the type of the claim or the cash flow, we talk about the debt markets and equity markets, right? And then we move to the duration of the market, which means the maturity, that is capital market and the money market. I think that is the place where we stop that day. Now, as I said, financial market is classified based on the maturity date. Maturity normally spans into two terms. One, from overnight to 1 year's time. Second, 1 years to indefinite period. We don't know. Some instruments are uh, for indefinite periods, which means there's no maturity date, specific date. So capital markets are actually the long-term markets, which means greater than 1 year market. The maturity would be greater than 1 year. Why do we need a capital market for a financial system? In this market, people raise long-term funds. People take a long-term view in this market. Now, other than this capital market, only way to have a long-term view for uh, players in the financial market is the banking or the deposits. When you have a deposit more than 1 year, I think most of the deposits up to 5 years, you can have view for a longer period. Other than that, you don't have any other way to take a long-term view or having transactions with the long-term tenor that is facilitated by the capital market. So we observe raising long-term funds. Again, capital market can be divided into two sub-markets, stock market and the uh, bond market. Stock market and the bond market. The bond market is actually, we have already covered, it's like the debt market, right? So here we discussed the debt market. This is actually related to bond market. Now in the debt market, we have different instruments. We have loans, we have T-bills, we have T-bonds. Likewise, you know, the mix of instruments are there. Out of this, these T-bonds or corporate bonds, basically bonds, are considered as capital market instruments. Then we have the stock market, anyway, it's the long-term market. So in that sense, in the capital market, you have different instruments, treasury bonds, private bonds, we call them as private debt securities or debentures, corporate debt, sometimes we use that word as well, and then equities, shares. So in this market, main issuers are the government because government is issuing treasury bonds, banks are there, and corporates are there. So all in all, this market facilitates raising long-term funds to take a long-term view for the financial market players. So I told you starting from 1 year to indefinite period, you can have this market. Indefinite means for equities, you don't have a maturity. Other instruments you have maturity. Treasury bond can be 5 year, 10 year, 15 year, 20 year, likewise. A corporate bond could be 2 years, 3 years, 5 years, likewise. So it has a maturity. But for equities, you don't have a maturity until you hold it or until you dispose it from your end, that stays with you because these are company, the proofs of company ownership. So there is no maturity for that. Then the other part of the financial system in terms of maturity is the money market. Money market is considered as market up to 1 year. So from 1 day to 1 year. 1 day means you call it overnight. So from overnight to 1 year, instruments are traded in this market. We call it money market. Why money market is there? The importance of money market that provides liquidity, that provides short-term cash needs. For example, if you want to fulfill money for a shorter period, you basically rely on the money market. If you borrow or lend for a 3 month, 6 month period, you rely on the money market. If your instruments are on the rolling basis, which means you continuously raise money for your operations, that is from the money market. So in this market, the instruments traded are highly liquid and they are considered as instrument close to being money. For example, I have mentioned some examples here: treasury bills, repurchase agreements, commercial papers, all are considered as highly liquid instruments. Now, even these treasury bills and repurchase agreements, those are included in banks' highly liquid assets. I think in commercial banking, you might have studied these banks are required to have a liquid asset ratio, LAR. So in this liquid asset ratio, they can include treasury bills and repurchase agreements if they have as liquid assets, which means they are highly liquid. So one of the key characteristics of this market, securities are sold in large denominations. The reason is mostly institutional participants are there, like banks or some other insurance company, insurance sector, or a large conglomerate company. They are dealing in this market in large quantities. And also it is considered as low risk market, which means people do not default. The credit risk is low. Sometimes this market is trading even without a collateral. For example, sorry, in the money market, there are money market loans. So for these instruments, you can add that as well. Money market loans. So these money market loans, they are traded in the happening in the overnight or short term money market. Those are even without a collateral. Collateral means no security. When you have a treasury bill transaction, you have a treasury bill. When you have a repurchase agreement, you have some security. When you transaction with commercial paper, you have a security. But when you take a loan, money market loan, there is no backing security. But still, the market is very active because it is considered as low risky, low default risky market. Okay. Then we classify the market based on the settlement date, clearing date. Whether you are completing the settlement today or in a shorter period of time or in the future. Based on that, you can classify the market into spot or cash market and the derivative market, which means future market. Future market. So in the spot market, in the cash market, financial instruments are traded for immediate delivery. Instruments are traded for immediate delivery. Now, when you say cash market, sometimes the transaction is settled on the same day, very quick. Spot market maybe one or two difference is there, but still this is considered as immediate delivery without taking much time. So in the spot market, transaction normally happens on T+2 basis. So delivery of the instrument against cash will happen after 2 working days of the trade. Now, for example, if you uh, buy and sell foreign exchange today in this foreign exchange market, the transaction will be settled in 2 days' time. If you transact government securities, The transaction settles in 2 days times. Now normally treasury bill auction is held on Wednesday. So that is the date that you do the trading. But actually cash movement and the security movement happens on Friday, which means in 2 plus T plus 2 working days. If there is a holiday, then you have to adjust the date. Always you are trying to keep the gap T plus 2 working days. So spot market can be an organized market, exchange, over-the-counter market. It could be any form in the sense of the organization of the market, but it could happen for immediate delivery. The derivative market, future market, is basically for delivery in the future, not immediate. Now, in the derivative markets, there are various instruments like futures contracts, options, swaps. These are like derived from other assets, other forms of assets. Derivatives we are going to discuss in detail in the next session. So these are like some instruments for hedging. I told you that to minimize the risk, you do these derivative transactions or future transactions. So these are used to manage risk, as I said, or some people used to speculate. Future means it happens in the future. Could be in 7 days, 3 months, 1 month. Now, for example, some foreign exchange transactions are there for 3 months period or 1 month period for transactions. So all in all, these are settled in the future. You do the transaction today, but settle in the future. Then we can look at the organizational structure of the market. How it is organized, whether it's a formal way or an informal way. So based on that, we can divide market into auction markets and over-the-counter markets. Auction markets, sometimes you call it exchange markets. What do you mean by auction market? Buyers enter competitive bids in this market. Sellers enter competitive offers at the same time. So this market works for bids and offers. People bid prices, people offer prices. What does that mean? You are having a kind of a negotiation. Some claim each other, which means you are having some competitive behavior to do a transactions, which is basically an auction mechanism. So the price determined in the auction market represent the highest price that a buyer is willing to pay and the lowest price that the seller is willing to pay. And matching bids and offers are paired together and orders are executed. For example, uh, the best method or the place to understand this auction market is the stock market. In the stock market, when people want to buy, they enter competitive bids for securities. When the people want to sell stocks, they enter competitive offers. So by matching these offers and bids, the transactions are executed. Same happens in the government securities market. In the primary market, people come to the auction, primary dealers. They bid, and based on that, the transactions would happen. They sell it in the secondary market, then they have the offer price. So the transaction happens, then they make a difference out of that. Even in central bank open market operations, it is an auction market. competitive bids are offered, quoted by the market participants. So buyers and sellers of securities, they meet in a kind of a central location to conduct trade. So this central location, sometimes you call it as exchange. That's why you call auction market as exchange as well. So the best example, as I said, stock exchange. In the stock exchange, you have this exchange mechanism. In the OTC market, over the counter market, it's a decentralized market. There's no central location or an exchange and no central physical location. You cannot find out a central physical location for OTC market. And this is a very large market because it's spread all over the places everywhere. How it happens, market participants are trading with each other through various communication modes, through the phone, through trading portals, through internet, through fax, through messages. There are various ways of doing this communication. Through the communication, you do this. Now, for example, in the coal market, you just pick up the phone and trade money. In the foreign exchange market, you enter prices to the system, for example. So in this market, dealers act as market makers. So dealers are very powerful in this market by way of quoting prices that they're willing to buy and they are willing to sell security or currency. Dealers are the facilitators through the market. And these are not actually listed in organized exchange. Now, for example, money market is an kind of OTC market. Foreign exchange market is like an OTC market, and they are not listed in the stock market or exchange. Right? Now you can see from this picture various parties trading in this OTC market: Party 1, Party 2, Party 3, and there's no central location, physical location for them. One person may be communicating through the telephone. One person may be communicating with email. One person may be communicating through a trading system, electronic trading system. So I hope it's clear. There's no physical central location or no exchange. The transactions are happening in a decentralized way. So those classifications are based on this first this slide where we identified financial markets classified based on the claim, maturity of the claim, timing of delivery, and the organizational structure. Okay, so those things are covered up to this point. And in addition, by looking at the volumes of transactions, we can classify these financial markets into retail markets and wholesale markets. In the retail market, transactions are happening for day-to-day purposes in terms of banking, providing savings facilities, credit facilities to individuals, families, and small businesses. So these transactions are very small and very simple, and also could be on a day-to-day basis in the retail market. Now, for example, what we do as customers in banks or financial institutions, our transactions are retail transactions because we don't do large value or bulk transactions in the financial market as individuals or even small families small businesses, retail transactions. That's why the bank interest rates offered to customers, normal customers, they use a word as retail interest rates. And as you are aware, they have retail banking now. What do you mean by these retail interest rates? Interest rate offered to individuals for their transactions. Wholesale market is actually by name available for large quantities. Generally, this is dominated by interbank transactions. Now, banks are doing transactions among them to facilitate their or fulfill their funding needs. Those are actually not very small amounts, they are billions of money. You call it as wholesale financial market transactions. Banks do this wholesale banking. Now in UK there is a famous concept called wholesale banking, offering money or transactions for uh, big players like banks or large companies to fulfill their needs in large quantities. Wholesale market.
Excuse me, sir. Wholesale market can call as corporate market, isn't it?
Yeah, corporate market is actually a kind of a one feature of wholesale banking, wholesale market. Yes, because corporates are actually dealing in very large quantities. Now in Sri Lanka, some banks they are only into mainly into corporate banking. For example, foreign banks they do corporate banking. Uh, Domestic banks they mainly do retail banking and plus corporate banking, isn't it? Likewise. Then we have another important market segment for foreign currency transactions. We call it as foreign exchange market. Foreign exchange market, we use various terms. I have listed these names because sometimes we use these terms in the financial terminology. We call it forex market, FX market, currency market, whatever the term we use, it's referring to the foreign exchange market. Now, this is a global decentralized market for trading currencies. Global market, foreign exchange market is the largest market in the world because we have currency trading in any part of the world and that is decentralized. So, in that sense, it's an OTC market. Foreign exchange market is an OTC market, over the counter market. As I mentioned, in terms of volume, it's the largest market in the world. In this market, the relative values of different currencies are determined. Or in other words, the price of currencies are determined, which means the exchange rate. Exchange rate is determined in this market. How? People demand FX, people supply FX in this market, and through that interaction, the FX rate, foreign exchange rate, is determined. This is a very important market in terms of determining the price of currencies. Why this market is important? That is assisting international trade and investments by way of enabling to convert currency in this market. People bring different currencies and convert into other currency in this market. For example, people buy dollars, bring dollars, they want to convert into rupees. So how they do it? They do it through the foreign exchange market. And you want to have some foreign exchange for your transactions. You come and buy in this market. Now, in the foreign exchange market, there are actually two types of transactions happening. If you look at the structure of foreign exchange market, there are customer trading, right? Customers are trading with the dealers. In the foreign exchange market, we have dealers. I told you it's an OTC market. In an OTC market, dealers are acting. Can you remember the definition of a dealer? He buys or sells instruments for his account to make a profit. Remember, a primary dealer buys securities to his account and later sells for a profit. Banks are buying foreign exchange for their account and later sells for the profit. So they are dealers. These dealers do transactions with customers mainly, right? Different customers do transactions with different dealers. And also there are interbank trading. Interbank trading means among dealers. If dealer is a bank, among banks they do need to have transactions for currency. So that is facilitated through a broker mainly. There could be direct transactions also. Now, according to this diagram, there are direct transactions also between dealers. But we also observe brokers are there because they are helping to find out the best price for foreign exchange. Now, in Sri Lanka also we have this structure. Customer trading and interbank trading are there. Customer trading means customers come to bank and they do foreign exchange transactions, which means with the dealers. And among banks also there are transactions. Sometimes we observe that is happening uh, through the direct method, and all, or they are going through money brokers. In Sri Lanka, we have money broker industry. So these money brokers are helping to do the interbank trading. Okay. So those are the two types of transactions happening in the foreign exchange market. So that leads to an important discussion. So here we spend some time to discuss some of the important concepts related to the foreign exchange market. So the first and important concept that we can understand is, or we can discuss, is the exchange rate. What do you mean by exchange rate? Very simply, it's the price of one currency in terms of another currency. Make it very clear. The rate at which one currency is exchanged against another currency. For example, what is the rate that the LKR trades with USD? If you are paying certain amount of LKR to buy the USD, that indicates the price of that currency in terms of your own currency. So that suggests the number of units that you are paying from one currency in the exchange of another currency. Okay. If you say a USD is LKR 200, that indicates you are exchanging one USD with 200 LKR. Now this expression of the exchange rate can be mentioned in two approaches. I'm just giving you these terms because in some books you might see these terms. What is this approach of expressing the exchange rate? We call them as quotes, quoting the exchange rate. One way is direct quotation. The other one is indirect quotation. So in the direct quotation, you express cost of one unit of foreign currency in terms of local currency. Indirect quotation means cost of one local currency is given in terms of foreign currency. Now here we have an example. Let's say we have two currencies, USD and Euro, right? Dollar and Euro. Now let's consider Euro is the local currency. Now how do you express the direct exchange rate and indirect exchange rate? So here we have some quotations given. If you are expressing the direct exchange rate for Euro and dollar, how do you do? You exchange the cost of foreign currency in terms of local currency. So the example says 1 USD, which means the cost of foreign currency equals 0.928 euros in local currencies, right? So it's very simple, expressing the foreign currency in terms of your currency. Indirect exchange means the other side, simply expressing the one unit of local currency in terms of foreign currency. So indirect exchange rate is 1 euro, which means your local currency, equals 1.08 USD. So this is very simple to understand. Indirect exchange rate is the reciprocal of the direct exchange rate, which means if you take this indirect exchange rate, it is actually 1 divided by 0.928. You don't have to do these conversions in the exam, but just have some idea what you mean by direct and indirect quotation. Because in the financial markets, you can see these terms used by players. The exchange rate has two major definitions. One is the nominal exchange rate, the other one is the uh, real and effective exchange rate. Now, nominal exchange rate, we already know actually. Now, when you say LKR 200 equals 1 USD, that is actually nominal. You simply mention in terms of nominal value. Now, here I have a chart from the for the USD movement in Sri Lanka for up to last year. You can see this is moving from various levels, 150, 80, 90, 200, and again 195 likewise. This is nominal exchange rate, expressing the foreign currency in terms of local currency. That is the direct way of quoting, right? Now, in order to use the exchange rate to understand the uh, behavior, the behavior of the exchange rate, as well as use it for policy making, we cannot only look at the nominal rate, because this doesn't give us very clear idea about the factors behind. We can't make a simple judgment. We can't make a judgment by simply looking at this nominal rate. For that matter, we look at the idea of effective exchange rates. Very simply, effective exchange rate is a combination of exchange rate. Now here you only have one rate, USD rupee. In the effective rate, you have basket of currencies. For example, let's say you are having a five currency basket as the effective rate. You might have dollar, you might have sterling, you might have euro, you might have yen. Likewise, you have a number of currencies in a basket if you want to calculate the effective exchange rate. Why do we need it? We need to understand the country's overall competitiveness. We have to have an effective rate. That is the purpose we calculate this. In the nominal rate, you can only have one rate, and that doesn't give any idea about our competitiveness. To understand the competitiveness, we need to have the movement of key currencies of the country that you are using for trade. You are not only trading in dollars, no? You might be trading in sterling, trading in euro, yen. For example, if you are importing or exporting with Japan, you have to use yen. If you are doing it with the European region, you have to do it with euro. So you have to consider the movements of those currencies as well. That's why we have this idea of effective exchange rate. There are two types of effective exchange rate. One is the nominal effective exchange rate. Very simply, nominal is basically the combination of this nominal currency. Now, let's say in your nominal basket, nominal effective exchange rate basket, you have four currencies: dollar, sterling, yen, and euro. You have these four currencies in your nominal basket. The weight of these currencies is dependent on the size of the trade. Let's say you are doing more trade with USA, then your dollar weight is high. You are doing less amount of trade with euro, your weightage is low. So simply, this is the weighted average of major bilateral nominal currencies. In the nominal effective exchange rate, you call it near. Another version is there, real, which means real effective exchange rate. Now, actually, in order to understand the competitiveness of a country, competitiveness means how best you can trade with another country based on your cost. People will trade or buy and sell your goods, buy your goods if your cost is low, right? If your cost is high, people will not buy. Your export will not have a demand. Competitiveness means that. To understand that, you have to look at the inflation rates of these currencies. Whether inflation for dollar is high, whether inflation for euro is high. Likewise, inflation for these currencies have to be considered in your basket. So when you consider inflation variations into your currency basket, you call it real effective exchange rate. Always, I think you know the idea of real means it's always inflation adjusted. Okay. Now you can see the movements of the nominal rate and the real rate. This is for Sri Lanka. Now, if you look at the nominal rate, it is going up this way. This indicates depreciation, right? In the case of effective rate, the depreciation is measured if this line is going down. Now, these are near and real. Near and real means currency basket. So you can see that the line is going down compared to a base. The base is 100. It's So compared to the base, you can see your currency value is going down, which means depreciating. So if you look at if your currency is moving into different directions based on the real near index, you can understand whether the currency is depreciating or appreciating. Now in this case, in this part, you can see currency is appreciating. Why? It is going up. If it is going above 100, that indicates a substantial appreciation. In this part, you can see the currency is depreciating because it goes down below the 100. Now, if the inflation impact is much higher, you will see this is, moving into various directions. So all in all, I'm not going into further details into effective rate. This indicates countries' competitiveness in terms of appreciation of the or depreciation of the exchange rate based on a basket of currencies. Now, for this slide, you have to have some additional paper with you because there will be some additional discussion here. You have a limited information on this slide. I'm going to add some uh, information here. What is available in the slide is limited. I'm going to add more. Okay. So we are trying to understand various concepts related to the foreign exchange market. Now, first, in the first block, we need to understand different regimes of exchange rate. The first regime is pegged or fixed exchange rate system. Countries are pursuing or following various exchange rate regimes. Now, for example, there are some countries in the world, they have a fixed exchange rate regime. For example, countries like Hong Kong, their exchange rate is fixed. Even in Sri Lanka, for some time, our exchange rate was fixed at a certain level. In China, for many years, their currency was actually fixed, or you call it pegged. What do you mean by that? Fixed or a pegged exchange rate system indicates a price control system, or the exchange rate is controlled. How it is controlled? The government or the central bank is fixing the exchange rate and announcing it to the market. For example, government would say, okay, the rupee value is $100, 100 rupees for a dollar. So that is announced by the central bank. Now, up to 1977 in Sri Lanka, we had such a system where the central bank is giving a fixed value to the foreign exchange rate. Now, when you announce and fix, all market transactions should be done at that rate. Time to time, the authority can refix this rate depending on the conditions in the market. But this system is not preferred or encouraged in many countries because due to the problems associated with this system. Now, what happens when you fix the price, when there are large demands for money for foreign exchange, some other markets, black markets, gray markets, could be activated. That's one issue. The other issue, if you want to keep the exchange rate fixed at a certain price, as the central bank, you have to fulfill the shortage in the market. For example, if people need more foreign currency on a particular day, if the demand is high, the natural tendency is the exchange rate to go up. But you can't do it because the rate is fixed. How do you fulfill the gap? The central bank should supply the foreign exchange to keep the exchange rate at that level. So that issue is there. Other type of exchange rate regime is floating or flexible exchange rate system. Now these exchange rate systems are actually like, it's like a line, two lines. Now one extreme could be fully fixed. The other exchange end would be fully flexible. We are actually talking about these two ends, fixed and flexible, right? Two ends. But in reality, exchange rate could be in the middle. Now, some countries they might be having situation like this where it's not fully fixed, not fully flexible. Some currencies could be here. It's more towards flexible. Some currencies could be here. It's more towards fixed. So in reality, it could be different. But what we are trying to understand here is basically these two ends in order to understand the regime. So floating exchange rate system or a flexible exchange rate system indicates a free market mechanism for the determination of the price of money in terms of another currency, or price of one currency in terms of other currency. So free market mechanism means the demand and supply for foreign exchange is working in this market. The rate is determined from that interaction. Earlier, the rate is determined by the CB here. Here, the rate is determined by the market, demand supply mechanism. So there's no specific pre-announced exchange rate in this mechanism. Now, as a result, what can happen? Naturally, exchange rate becomes volatile. In this fixed system, the exchange rate could be like this, very stable. In the floating system, exchange rate could be like this. You can see from this chart, this is for Sri Lanka, you can see the exchange rate is very volatile, which means it's floating, not fixed. So as a result, in some countries, including Sri Lanka, given this high volatility, the central bank is intervening in the foreign exchange market. Why do they intervene? To stabilize, to bring some stability to the exchange rate. Because having large volatilities is not good. That could be disturbing the financial market if the rate is very volatile, very fluctuating, or largely fluctuating, it's not good. Okay. So you have to have some, in certain cases, intervention by the central bank to mute the large volatilities. What do you mean by intervention by the central bank? Central bank is buying and selling foreign exchange to meet the demands of the market. Okay. So as I said, these are some two extremes I covered, but there could be instances in between. Sometimes people use a word called managed floating. Managed floating means, for example, in this part, you might have managed floating, where the central bank has allowed some flexibility, but still manage. Okay. Any questions? I heard some message coming to the chat box. Does anyone want to raise any question? No? All clear? Right. So the first block is done. We are moving to the second block. තොරණේ දෙවනි කොටුවට යනවා. Changes in the exchange rate. Now, from this slide, you can see the exchange rate is changing. It's not constant. Now, in a fixed exchange rate system, as I said, the exchange rate is like this. Fixed. No changes. Changes can only be done by the authority. Now, for example, the central bank can take the rate here. In such cases, you call it overvaluation of the exchange rate. It's done by the central bank artificially or through its intervention. Sometimes the central bank may reduce the value like this. You call it devaluation. Right? It only happens in the fixed regime. But as we understood, in a floating regime, exchange rate is changing like this. Those changes are measured by appreciation and depreciation. So simply, the appreciation is the increase in the value of the domestic currency in terms of another currency. For example, let's say LKR value was 200 for a dollar. This reduces to 190, which means domestic currency value is increasing compared to the foreign currency. Depreciation is the other side, a decrease in the value of domestic currency in terms of the foreign currency. Earlier, rupee value was 200, now it goes up to 210 per dollar. So the domestic currency value depreciates. So if you take the exchange rate like this, so in this part you can see a depreciation. Sorry, appreciation. In this part you can see depreciation, which means you are paying more to buy a foreign currency. If you go back again to this slide, you can see periods of appreciation and depreciation of the exchange rate in Sri Lanka, rupee against dollar. So in this part, you can very clearly see you are paying more. The value of the local currency goes down. Here also the same in this part. So these periods are depreciation of the exchange rate. At the same time, you can see there are some periods, I'm circling them. You can see the value is actually going down in terms of your local currency. What you are paying is less now. So in such situations, you call it appreciation. Now you can measure the amount of this appreciation and depreciation using a simple formula. Now, for example, let's say these days central bank says, okay, our currency has depreciated by 8%. How that is measured? Using a simple formula like this. E1 minus E0 divided by E0. What do you mean by E1? E1 means the current exchange rate. E0 means the previous exchange rate divided by previous exchange rate multiplied by 100. Then you get the rate of the change, whether it is an appreciation or a depreciation. Okay, I hope it's clear. Shall we do a simple exercise here to understand how to calculate the appreciation and depreciation? So I'll give you two values. Let's say we have two currencies, dollar and euro, right? Now say in the period one, in the period one, earlier period, let's say at time t, the exchange rate between the dollar and euro was 1.25, which means you pay $1.25 to buy a euro. In T1, let's say it has increased to 1.35. In other words, to buy a euro, you pay $1.35. So my question is, during these two periods, what is the rate of appreciation or depreciation of the exchange rate? I think we can see the exchange rate has depreciated from these numbers. Why? Earlier you paid 1.25, now you pay 1.35. Obviously, what you are paying has gone up, which means your rate has weakened, depreciated. Now the question is how much the rate of depreciation. Can you try please? Very simple calculation. Let me know the rate of depreciation.
%8.
8%. How about others?
8%, sir.
8%. Very simple, no? Now, this is how we have calculated the USD depreciation, rate of depreciation. When you say 6%, 7% depreciation, it has been calculated that way. Right. Let's move to the next block. Types of exchange rate trades. Now, in the market, there are various types of trades happening. We can term them as spot transactions, term, cash, forward. I think we already have some idea about these different types of transactions. Can you give an answer? What do you think? What do you mean by spot transactions? Any idea?
Doing the transaction in the over the night.
Okay, not exactly over the night, but I think you
T
have the idea, which means for immediate delivery.
immediately T+1, T+2.
T+2. Yeah. Spot is a trade of foreign currency for delivery on the second working day from the trade. Clear? Spot is a trade of foreign currency for delivery on the second working day from the date of transaction, which means the settlement happens in 2 days after the transaction. Now, why these 2 days given? Oh, it's there. Most of the transactions happen on this basis, T+2, to attend necessary formalities and due diligence for remittances of the funds between the party. Due diligence means actually for the transactions is a very important concept. You check the, you have to follow due procedures, check the authenticity of transaction. A lot of things have to be done. Now, for example, if you are having some shortage of the cash to make it, to arrange it. Likewise, some space is given uh, for the parties involved in the transaction. So the rate determined for this transaction, you call it spot exchange rate. If you are agreeing to a particular exchange rate for this transaction, you call it spot rate. So you may have seen in financial press, there are various terms, spot rate, forward rate, likewise. So these rates are determined based on this delivery date. Second type, Tom and Cash, not Tom and Jerry, Tom and Cash. What is Tom? Transaction for delivery of currencies on the next working day. T+1. There could be such transactions as well. Given the urgency of fulfilling the needs, people might enter to Tom transactions as well. Transaction happening today, settlement is on the next working day. But these are not very popular. There could be transactions, but not popular compared to spot transactions. What do you mean by cash? The exchange rates are determined if the transaction is done on the same day and the settlement or the delivery is done on the same day. For example, you do the transaction in the morning and in the evening you have to settle the funds as well. So that is t plus 0 actually, t0, t, time t. So such transactions are also there. The rate determined for such rates, you call it as cash rate, cash exchange rate. But as I said, the most common type is the spot rate. Third type, forward, we already understood from the previous discussion. Forward is a contract to deliver a currency at a future date at the exchange rate agreed today when you are entering into the transaction. So here the rate is applicable for the transaction agreed today, but the settlement will be in a future date. So the settlement date or the future date could be, the delivery date could be 1 week, 2 week, 1 month, 3 month, or any other period. Mostly we observe 1 month and 3 months in the foreign exchange market. If it is a very active market, very dynamic market, there could be 3 month, 6 month transactions. But mostly short tenor forward rates can be observed in many markets. Okay. So I think you can understand why people enter into these forward transactions. That is to minimize the risk. Now, for example, let's say you are importing a vehicle from Japan. When you import a vehicle, you do the transaction today, you buy the vehicle and you import it. But the actual settlement happens in the future, right? When it arrives to the land. There you have to pay at the prevailing exchange rate at that point, generally. But if you enter into a forward transaction, you can agree, you pay at the price of the transaction date, not at the settlement date. So by that way, you are reducing the risk of paying extra money due to the change in the exchange rate. It could be other way around as well. Even though you enter into a spot transaction, forward agreement, it could be other way around. The rate is moving not in favor of you. It could be appreciating. Then you will lose. So all in all, people enter into forward contracts in order to mitigate the risk of exchange rate changes in the future. Okay. Now, then we have another concept related to this forward mechanism or the forward concept in the last block, that is the forward exchange rate and forward premium. What do you mean by forward exchange rate? Rate at which banks are willing to commit to exchange one currency for another currency at some specified future date. as I said, it's actually coming from this forward contract. You are committing to a particular exchange rate at future specified future date. Now, when dealers, actually banks, quoting this forward exchange rate in a forward contract, they rely on very important factor, that is actually the interest rates for these currencies. Now let's say the forward rate is between dollar and euro. So when you enter into this forward contract and determine the forward exchange rate, you have to consider the interest rate for dollar, interest rate for euro. Why? These are money. You cannot lend or borrow money for future without paying any opportunity cost. No, remember, you have to pay cost of money. So the cost of money is given by the interest rate. So for forward exchange rates, the interest rate differential matters, which means the difference between the two currency interest rates or the interest rates of two currency will be a key factor determining the forward exchange rate. I'll show you an example. And then another concept is there, forward premium. Very simply, forward premium is the situation which the forward rate is greater than the spot rate or the spot price. So if you say forward exchange rate as FP, current exchange rate as SP, spot rate, the difference indicate the premium. If forward price is greater than the spot rate, you have a positive forward premium. In other words, there is a premium. If forward rate is lower than the spot rate, there is a negative premium, which means actually a discount. Okay. So this premium, you have to have some idea. Now in our paper, most of the questions are related to this forward premium, not the forward rate, which means you don't need to calculate the forward rate. It's most of the time it's given, but you only need to calculate whether there is a premium or a discount. Very simple questions are there, but still people make mistakes. We will do some exercises. There are some exam questions for this forward premiums. Then you will understand it very clearly.
So excuse me.
Yeah.
This forward rate, basically this is to pay at the price of the transaction. Sorry, at the this is to pay the price, pay the price on the date of the transaction on a future date, right, sir?
Yes, yes, yes.
All right. Okay. Right. Thank you, sir.
You calculate that future price based on today's exchange rate. Clear? But at the time of the transaction, that exchange rate could be different.
Okay, sir. Thank you.
Now let's say today exchange rate is 200. Okay. You enter into a forward contract to do the transaction in the future date at 205. That 205 is calculated based on what? based on 200 today. Otherwise, you don't have any way to predict it. No, you can't do, any magic for them, right? You have to have some mechanism to do that. You will do it based on today's exchange rate. When you do it, you take these interest rate differentials and calculate the forward rate. But actually, let's say it's a 3-month rate. By 3 months time, at that particular date, the rate could be not 205, it could be 208. Then there is a difference, right? From that difference, you might be gaining a loss or a profit. That's a different thing. Okay. What I am saying now, today you enter the price spot as 200. When you calculate your future rate based on this 200 today and interest rate differentials, if it becomes 205, what do you have there? Is a forward premium or a discount? It's a premium. Why? Your future rate is greater than the current rate. From the interest rate differential, this could be other way around. For example, let's say the future rate becomes 199 from the calculation. What does that mean? There you have a negative premium, which means the future rate is lower than the current rate, which is a discount. That also can happen, right? I hope I made it clear. Any question? Yeah, I think I have given you the details what I was discussing. Forward is a contract to deliver currency at a future date at the exchange rate agreed today at the time of entering into the contract. That's what I think one of our students very clearly repeated this. This is the definition. So the rate agreed in a forward contract, we refer it to as the forward exchange rate. Forward rate, or sometimes you call it forward price, the same thing. So profit or the loss of the forward contract depends on the difference between forward rate and the spot rate prevailing on the forward contract maturity date. Forward contracts are used to mitigate exchange rate risk that would be arising in the future transaction through the changes in the exchange rate in the transaction. I already mentioned this one as well. Dealers quote forward exchange rate in the forward contract on the basis of interest rate differentials between two currencies. Now, theoretically, this is discussed under covered interest rate parity, CIP. We are not going to discuss those things. It's a theory. But if you turn a finance book, you will see a concept called covered interest rate parity that is actually related to this forward interest rate, forward exchange rate concept. I already mentioned to you forward rate is referred as forward rate or the price. It's the exchange rate at the bank agrees to exchange one currency for another currency in a future date. Now, one of the important thing why this forward rate is used by the banks and the financial market players, we consider this as an unbiased predictor of the future spot rate. Now, let's say the exchange rate today is 200 spot rate. You calculate forward rate as 205. Now we consider this 205 as a unbiased predictor of this spot rate. Unbiased means the market contains all available information and the market is efficient and there's no arbitrage in the foreign exchange. Arbitrage means you cannot gain extra profits in this market theoretically. Well, simply the idea is this 205 very clearly indicates the spot rate today we have as 200 will exactly be 205 in 3 months time, as we have captured all information, all interest rates into the the equation. That is the idea. But in some markets, this may not work, because in some markets there could be some distortions, there could be some black markets activated, there could be some currency conversion not happening. There are various reasons to forward market becomes very inactive. In certain cases, this might not happen, but theoretically it is considered as a very good predictor for the future spot rate. So here we have done, I have shown you some calculation. I'm not going to do any kind of a exercise here in relation to this calculation, because we don't have that in our exam. But I just wanted to show you the way to do it and also to understand the principle behind the forward and spot rate. Now I told you interest rates are taken into consideration when calculating the forward rate. So in this formula, this F is forward rate, S is spot rate, right? Here in this part, we have interest rates considered to calculate the forward rate using the spot rate. What are the interest rates we have? RD, RF. RD means the domestic interest rates. RF means foreign interest rates. Now, for example, if you are calculating the forward rate for USD in terms of rupees, what are the interest rates you take? Interest rate for rupee, interest rate for dollar. RD means local or the domestic rate, which means rupee interest rate. RF means the foreign interest rate, which means the dollar interest rate, which is the US interest rate. So taking into those consideration, we calculate the spot price, future forward price. Now I gave you some numbers, no? 200 spot price today, 205 future price in the future. So this 205 is calculated using this 200 spot price as well as these interest rates. So this 205 captures the interest rate for rupee and dollar. Right? Now for a expert who is in the financial market, foreign exchange market, by looking at the interest rate, he can say whether your currency would be trading at a discount or a premium in the future by looking at the interest rate. For example, let's say our USD rate interest rate is 1%. Rupee interest rate is, let's say, 5%. So these two interest rates suggest there is an interest rate differential. By looking at this interest rate differential, an expert can say, okay, your currency is going to trade at a discount or a premium in the future. So the message we can get out of this formula is the difference between the spot rate and the forward rate is coming from the difference between the interest rates between two currencies. If interest rate of one currency is higher than the interest rate of another currency, that will be determining whether your currency is trading at a premium or a discount based on the forward rate. So I given you some calculation also to understand how these numbers work for the same formula. So we have Canadian dollar USD example. CAD USD rate is 1.129. So this is the spot rate, spot price. So in the formula we have here, it has the spot price. Okay. 3-month interest rate on Canadian dollar and USD is 0.75 and zero point 0.4. So Canadian rate is 0.75, USD rate is 0.4. Now, can someone tell me why we have used this fraction 90 divided by 360, 90 divided by 360? What is the reason for that?
Because of 3 months.
3 months, exactly. Time factor. If it is 1 year, we don't need to have this, isn't it? So through calculation, you get the Canadian USD rate as 1.1249. This is the forward price. So do we have a discount or a premium for this exchange rate? The difference is positive or negative?
Positive.
Positive, which means the Canadian dollar would be trading at a premium in the future. Now, if you simply look at how this premium comes, the difference between the two interest rates, isn't it? 0.75, 0.4. So Canadian rate is higher than the USD rate. So that suggests if your domestic interest rate is higher, your currency would be trading at a premium. Okay. So here I think I have given you that explanation. The difference between forward rate and the spot rate is known as swap points. Actually, this amount, the difference in our financial terms, we call it as swap points. So if the sub point is positive, it is a premium. If sub points are negative, it is a discount. A currency with lower interest rate will trade at a forward premium in relation to currency with a higher interest rate. Okay. So US dollar is trading at a premium. I think I made a little mistake here. The mistake is actually if you simply look at the difference between the rates, your Canadian dollar would be, you are paying more in 3 months time in terms of Canadian dollar. That is why you have a premium here. Why that premium comes? Because your foreign interest rate is lower. Foreign interest rate is lower, and that would lead to a depreciation of your currency, right? So that part is explained here. I actually added this part, this in foreign exchange market. This is, some complex discussion, interest rate parity condition. I only inserted that for you to get some understanding about how these interest rates are impacting on the exchange rates. But at this level, survey financial system, you don't need to, go into that, complex discussion. I just added it to give you to give you a rough understanding how these interest rates are working. But this part is very important in this slide. This is in your exam. Definition of premiums, discounts, and calculating of premiums and discounts based on the FP and SP. These numbers would be given to you. But this part we don't need to do. We don't do any calculations. I just added this slide for you to understand how these interest rates are impacting.
Excuse me, sir.
Yes.
When it comes to forward exchange contracts, are the dealers fixing exchange rate below the current level?
Sorry?
When forward exchange contracts, are the dealers fix the exchange rate below the current level? That means
it could happen. It could happen. It depends on the prediction of the exchange rate based on the current spot rate and the interest rate movements, right? So interest rate movements, it's really difficult to predict. We don't know the movements of interest rate, but depending on the interest rate, there could be situations that your rate could be lower than the current rate. But normally, what will happen? Usually, the interest rates are not going to negative. No? Normally, interest rate will be having a positive figure, and most of the cases there is a interest rate positive differential in most of the cases. There could be negative situations also, but most of the cases you will see between two countries, the interest rate differential could be positive always. Depending on that, most of the time your future rate would be at a premium. But that doesn't mean you cannot have discounts. There could be situations of discounts as well. So in summary, the future rate can be lower than the current rate as well. There could be such situations.
So in that incident, the benefit goes to the client, no?
Yeah. Yeah. Okay.
Okay, so thank you.
Here. So let's move on. I think we spend a substantial time on this forward contract. But I think it's good we understand the concept and why it is important. Commodity markets, another type of market. Why we study commodity markets under this financial survey? The reason is clear, because these markets are important because some financial transactions are based on these commodities. For example, there are some exchanges, derivative products built on these commodities. For example, on gold, on other base metals, on oil, there could be financial products, derivatives built on these markets. So in the market, global market, there are various commodity markets, exchanges in relation to financial products. So that's why I inserted this slide. And also there are some informal financial markets in most of the economies, especially for rural areas, agriculture societies. There are some uh, people who are lending and doing transactions uh, for fulfilling the money demand, for fund demand. For example, these informal money lenders, these are like informal markets. I think even in Sri Lanka, there are various informal sectors. In these markets, the credit taking is very simple. You don't have to have too much worry. transaction costs are low, but funding costs may be higher. The reason is you have to pay high interest rates in this market. But most of the time we see repayment is very high in this market, informal markets. For example, you take a loan from a Poli Mudalali, you pay high, but you pay on time. Otherwise, the damage would be really high. So there's an important, but we cannot simply rule out this market because informal markets are providing some services to certain segments. The only thing is we should be able to bring this market into formal setup, right? Then we need to look at the international markets as well. So international markets, definitely these products are traded in international markets, bonds, equities, etc. In the international markets, there are various kind of a different type of markets. For example, bond markets are there. Different instruments are traded there, like foreign bonds, euro bonds, euro currencies. These are various types of bonds, and also we have various types of stock markets operating in the international markets. And these stock markets are really important for us to understand the movements of the direction in financial markets, because some people very closely monitor these international markets because that is important for the local market context as well. I just need to have some more time to go through these two slides, the foreign bonds, euro bonds and euro currency markets. The reason is this part is very important because this has become one of the key instruments in modern times. Sometimes we call them as sovereign bonds, ISBs, right? People talk about these ISBs, international sovereign bonds. This is related to euro bonds. So we would need some time to cover up that idea. So I'm not going to touch on this right now. I think we only left with 10 minutes from this point onwards. So my suggestion, please look at these slides towards the end of the presentation. This is actually related to our local context. I suggest you look at the central bank annual report. There is a chapter 8. In the chapter 8, there is a section on these financial markets, right? Few pages are there. So I really recommend you read it before you come to the next class, right? Let's discuss based on this chapter and the information available there. The rest of the presentation, couple of slides are related to that section in the annual report. So let's try to get some understanding from that part. Okay. So we'll stop at this point then. Let's start the discussion next week from these international markets. And I hope you have very good understanding. And at the same time, can I request you to go through the past papers? There are a couple of past papers with the questions related to this forward premium, right? Forward premium and exchange rates in the past papers. So please try to answer those questions, and next week we'll find some time to discuss the answers, right? If you do it on your own, that would be really easy. Then we can go through the answers very quickly, especially the calculations in relation to forward premiums and the exchange rates. Agree? Students?
Yes, sir.
Okay. So I hope you will do two things I requested. Try to answer the past paper questions in relation to exchange rates and premiums. And then please look at the financial markets section in the chapter 8 of the annual report. Right? Okay, let's stop at this point and have a good weekend. Stay safe. We are meeting at the same time next week, 8 o'clock, Sunday.